Mike, walk me through some of your thinking about the longer term cost and consequences of these programs, because those are real too, right? The addiction to Fed liquidity, and that dates back to before the pandemic, by the way. The mushrooming deficit, right, to a scale heretofore almost never seen, certainly not in post-war history. The enormity of the Fed's balance sheet.
Well, I think there's a few aspects to it, Eric. I think one is, and we're very conscious too, is that we don't want to see consumer, small business, big business come out of this in a indebtedness position that's just unsustainable. And that's why I think you've seen in a number of these programs that they've been structured in a way that they're actually grants or have aspects of forgiveness in them, provided the monies are used appropriately. And so the government's thinking about the same thing. We don't want to end up with an economy where our consumers and our business are just saddled with untenable levels of debt. I think the second piece, which you touch on, is actually where do the governments come out? And I think we've got to be mindful that while going into this, the U.S. from a position of strength in terms of the economy growth rates, employment, um, from a monetary and a fiscal perspective, not without some challenges, right? When you think of the toolbox out there, not just in the US, but around the world, low rates, negative rates in some places. And so, not a lot of things on the monetary front that can necessarily be used with high impact today, which leads us to fiscal. And the fiscal programs being put in place in terms of small business lending and payroll protection and Main Street lending programs that are out there. And that clearly will take up the levels, or as some people would say, balloon the Fed's balance sheet. And by the way, other balance sheets. And we've got to be mindful that we do not want our government in the US or other governments to come out in a position where the debt the government level, the federal level, is untenable because again, we're likely to be in this slower growth environment for an extended period of time, and we've got to make sure that we've created that balance in terms of people continuing to have confidence in terms of not just the U.S. government but governments around the world.
So, in your mind, how does the government exit, as it were? There are some people who say they don't government doesn't need to, right? Monetize the debt, embrace modern monetary theory. And then there are others who say, as soon as is practical, we're going to have to raise corporate taxes. We may have to raise tax rate on individuals, certainly wealthy individuals. We're going to have to start to chip away at the mountain of debt that we've created as a result of doing the right things to fight this crisis.
Well, again, I think that as you look at this, that we've been in this extended period of fairly lax or easy monetary policy, not just in the U.S. and around the world. And if you go back and look at the Fed balance sheet coming out of the last financial crisis, they were on a path, on a trajectory of getting that back down to, I think, levels that people were becoming much more comfortable with. Obviously, with this, we've had to go back in the other direction. And as we try to get to the other side of this and hopefully come out in the not too distant future, it's going to be back on the table. But as you cite, a couple of things that are out there is that one is the U.S. does continue to be the world's preeminent reserve currency, and when you look at our treasury auctions and others, it has a very strong international borrowing base and therefore has capacity. I think the second piece of it, and I don't want to be lulled into a false sense of complacency, but the low interest rates impose a very low cost in terms of the US government borrowing to be able to fund these programs that are out there. So, again, I think we've got to be prudent. We've got to be mindful in terms of the absolute and relative levels of our indebtedness. And we do have to have a trajectory to get it back to a more sustainable level over time. But I still think we're in a reasonable place right now. And it goes back to how long this goes on for. And again, what needs will be in the future and what kind of commitments it will take from not just the US, but other governments around the world to be able to support their economies. We don't know exactly what the path will be like. And so we've got to be very, very mindful of that. I think the US system, like Citi, comes into this from a position of strength. And as part of that, in the first quarter, you saw us build, again, as a company and as an industry, considerable reserves. We built almost $5 billion of additional reserves. We've got about $23 billion of reserves right now set aside. And again, we'll continue to watch as we go forward. And as you can imagine, the calculations and the modeling that we do remains very sensitive to unemployment. It remains very sensitive to GDP, to housing prices. And so as we continue to look at what we think the future trajectories are of those, we'll continue to make appropriate decisions around reserving into the future. So again, a position of strength, I think trying to be prudent, smart about it, making sure we're there and the important things to support our clients, but being mindful in terms of capital and capital trajectory into the future.